Artificial intelligence, or AI, is the talk of the town these days, and the AI industry has gained its second wind in the stock market, thanks to the excitement around the launch of ChatGPT by OpenAI. If you haven't tried it yet, it's an AI-driven chatbot that can answer your questions better and faster than Google. If Google gives you the links to the websites and content that answer your questions, ChatGPT takes it one step further and comes back with a well-articulated compilation of answers to your questions, saving you hours of reading and digesting information. In a way, artificial intelligence is replacing your human intelligence in doing some of the work you're doing now, giving you time to do more in your life. In other words, artificial intelligence can drastically increase human productivity, which has got everyone excited at the edge of their seats. Companies that can improve human productivity will change the world, and all investors want to have those companies in their portfolios. So today we dig into the role of AI in improving productivity, how and which companies are bringing AI to assist humans, and which ones are worth the spot in your portfolio because they can give you a 10x or 1,000% return. As always, this episode is based on my personal research and is not a financial advice. You should learn how to do your own research or talk to an advisor if you need help. My name is Hodam, founder and CEO of StockCard, and I've been thinking about what it takes for an AI stock to jump 1,000% in 3 to 5 years. At a high level, stock price growth is possible in two ways: a dramatic shift in the market sentiment about the stock, or a drastic improvement in the fundamental strengths of the company behind it. The dramatic shift in the market sentiment is typically very difficult to predict because unique events mostly drive it. For example, when COVID hit, the stock price of vaccine producers exploded thanks to investors' excitement about vaccine stocks. The news that the AI industry is now advanced enough that you and I can use a product such as ChatGPT is one of those shifts in the market sentiment that puts the wind behind the stock prices of AI companies. The AI industry is expected to grow roughly 40% annually between 2022 and 2030. This means if there were no other variables, and an AI stock market could grow at the same pace as the overall industry, in 7 years we could achieve a 10x return. But as we know, market growth is only one variable impacting stock price growth. Other factors such as profitability, free cash flow, and balance sheet impact the price as much or even more. To achieve an explosive stock price jump, we also need the company's operations, financial performance to signal the possibility of improvement in its revenue and profitability so that we can get to our 10x return faster than the market's expected organic growth in 7 years. If you started watching this video just to get a list of AI stocks to invest in, you are in it for a treat. But hold on for a few minutes. Before talking about the specific stocks, I'd like to share a very interesting story about how, once upon a time, Tesla's strong fundamental strength drove its stock price. Understanding that pattern helps us better evaluate the 3 stocks on our list today. If a company has the opportunity to grow its revenue in the next few years and it can also reduce the cost of producing its products or delivering its services, meaning better margins, you will end up with an explosive stock price jump possibility in 3 to 5 years. In the case of Tesla, aside from all positive EV market sentiments in Elon Musk's tweet, its stock price exploded over the years based on its operational strengths. It used to be very expensive to build an electric car because of the high cost of EV batteries. Tesla needed a lot of money to manufacture one car. But as it started to grow its manufacturing capacity, the cost of electric vehicle manufacturing also declined. Between 2008 and 2021, the cost of EV battery packs declined by 87%, enabling Tesla to manufacture its cars with higher and higher profit margins, which is the fundamental reason the company's stock price exploded. If you compare Tesla's stock price before it became profitable and after, you can see the impact of revenue growth on profitability. Tesla turned profitable in 2020 when the stock price took off. By the way, I had done a live stream on Tesla stock and whether it can continue to grow to become a 100-bagger. I leave a link to that video in the show notes. Regarding AI stocks, as we research the stocks to invest in, we should assess their ability to improve profitability, generate free cash flow, and grow margins like Tesla did. Now, which 3 stocks are on the list today? I used a rather clever methodology to find today's top 3 AI stocks. I first found 5 exchange-traded funds that invest in artificial intelligence. Then I took their top 25 holdings and found the most shared stock across all 5. The list includes well-known companies such as Nvidia, Tesla, Qualcomm, Microsoft, and Alphabet. All those well-known names tend to be great long-term holds. But it's difficult to see Alphabet giving us 1,000% return because its market cap has to jump to 13 trillion to achieve such a goal. There are some smaller names on the list with a market cap lower than $10 billion, which are much more feasible to assume the possibility of a 10x return. Therefore, the 3 AI stocks with 10x growth potential that we will research today are UiPath, Cognex, and Ambarella. First up is Ambarella, ticker AMBA. It builds high-definition video and image processing semiconductors and makes software that uses neural networks processing to enable devices such as autonomous cars and drones to perceive their environment and make more intelligent decisions. Ambarella software makes a self-driving car or drone to see better. They call it computer vision, or CV for short. Ambarella grew its revenue by double digits per year in the last 3 years. It boasts a 60% plus gross margin, and despite not being profitable, it generated free cash flow in the last 3 years, giving us confidence in its business model. It has solid balance sheet with 2 times in cash versus total liabilities. On the negative sides, the company is priced at more than 10 times its sales, which tells us investors are already excited about its future. And as evidenced by the growing R&D expenses, it still needs more capital to develop its products. Also, the chip industry is notorious for its cyclical nature. I've been used to own the stock when it was more a chip manufacturer and less focused on AI-based software, which is the source of its revenue growth in the last few years. But I sold it at a loss because I wasn't sure about the cyclical return of the stock price and I needed the money for other investments. The next AI stock on the list is Cognex, ticker CGNX. Before doing this research, I wasn't familiar with CGNX. The company makes the devices, software, and algorithm, factory and production facilities used to monitor their production line. This could detect a faulty product going through the production line or scanning barcodes as their products are ready to be shipped. They call it machine vision, which aims to improve productivity in the world of manufacturing facilities using AI. This is not as sexy as building eyes for drones like what Ambarella is doing, but when it comes to investing, the unsexier it is, the more exciting it gets. In the last 3 years, revenue has been growing in the mid-teens despite challenges in 2022. It's profitable, positive EBITDA, free cash flow, and 70% plus gross margin with solid balance sheet and no significant liabilities. It's priced similarly to Ambarella at roughly 10x sales and 45 times earnings, which is very expensive by such common valuation metrics. I want this stock to be cheaper so I can scoop up some shares. But before we decide on that, we have one more stock review, and once again, it's a company that uses AI to improve human productivity, and it's called UiPath, ticker PATH. Cognex improves productivity in a manufacturing line, and UiPath improves productivity in enterprises by automating their operations. For example, before I started StockCard, I used to work in the sales strategy of a tech company in Silicon Valley, California. One of our challenges was that tracking sales orders and confirming the actual orders with payments received by the accounting team was done by humans using Microsoft Excel. I used to joke that we run $1 billion company on the back of Excel files. UiPath could have come in and automated that process, replicating the work folks in the sales and accounting team had to do over hundreds of hours in what was known as sales operations. To me, UiPath's need and market opportunity is very, very tangible. Not too different from Cognex. UiPath's revenue grew by mid-teens in the last 3 years with negative growth in 2022. Similarly, it used to generate free cash flow but turned negative in the last few quarters of the last year. While it is not struggling with its debt, it carries some liabilities on its balance sheet. Gross margin ranged between 65% and 72% in the last fiscal year and quarter, which is solid. Let's wrap up and decide which stock is worth investing in now. We discussed how artificial intelligence is expected to improve human efficiency in the coming years and decades, and found a list of companies most invested by the top ETFs that focus on the AI industry. There are well-known names such as Nvidia and Tesla, and there are also smaller companies with market caps lower than 10 billion that have a higher chance to explode and give us a 10x return in the next 3 to 5 years. We looked at Ambarella, ticker AMBA, Cognex, ticker CGNX, and UiPath PATH. Ambarella has the smallest market cap and fastest revenue growth among the three stocks, but it is in the cyclical chip industry and is priced 10 times its sales. Cognex is growing in the mid-teens with profitable and free cash flow operations despite some challenges in 2022, but is also priced at 10x sales. And lastly, UiPath has had a tough time growing in the last few quarters and it's not profitable yet and has had negative free cash flow in the last few quarters. In my opinion, all three companies have the potential to soar. I highly recommend you don't stop here. Do your own research by looking up and comparing all three companies using their stock cards. I'll leave a link in the show notes for all three. And if you are new to the stock market, I recently published a video about the top 5 personal finance and investing myths you should avoid that is worth watching after this video. The link to it is also in the show notes. I'll see you next time.